today's our topic is Introduction to Financial Markets. When we talk about financial markets, these are the markets which help the economy to sustain and also run the businesses without any loss of money and also generate a lot of economic activity. So the contents we have financial systems and components, financial assets and institutions, financial markets and functions, we have capital markets, money markets, primary markets, and we'll also look at who are the market participants because of whom these markets are vibrant. So going forward, what is the financial system? Financial system, it's an institutional framework existing in a country to enable financial transactions. The financial system of an economy works through the financial markets and institutions. It has three main components. The first component is the financial assets. The moment we talk of an asset, we imagine a house or a car or something more tangible. But when we are talking about financial assets, it all falls back into loans, deposits, equities, bonds and such instruments which help the economy and the investors save their money and also people who are in requisition of money to raise the money. Then going to the second component, we have financial institutions which has banks, mutual funds, insurance companies. As you are aware, banks are no more only accepting deposits and giving away loans. We have a lot of financial services which are being offered by banks these days. So be it a mutual fund, be it an insurance that you want to invest into, all the banks, both private and public, are into offering all of these services. So in addition to the banks, we also have separate financial institutions which only work into the mutual fund space or into the insurance space. So that's about the financial institutions. Going forward, next we have financial markets. When we have assets and institutions, if there's no marketplace where these two can work. So financial markets include money market, it has capital markets and forex markets. So we will cover what each of these markets has to offer, what are money markets about, what are capital markets about and what are forex market all about. When we are talking about so many players, then regulation is again an utmost important concept. So there are several regulatory bodies which regulate the functioning of all of these components in an economy. We have RBI which regulates the banking system. We have SEBI, that is Securities Exchange Board of India, which regulates the markets, the financial markets that are again categorized into capital and secondary markets. And then we have IRDA which regulates the insurance company functions in Indian markets. So these are all the regulatory bodies which are operational in the Indian subcontinent. Now each of these bodies have laid down rules and regulations for players in each of these sectors, be it a bank or an insurance company or a firm which wants to raise money from the capital markets. So it is not just a simple process, they'll have to follow the regulations laid down. The compliance aspect is very important when anybody wants to use the services or access any of these institutions and under the financial markets and financial systems. Let us look at what are financial assets and what are financial institutions. Now financial assets, these are the assets which help us to channel from surplus entities to deficit entities. Now what are these surplus entities and what are deficit entities? Surplus entities are those individuals or corporates or government bodies which have money in excess of their requirement. That means the amount available with them for their own use is much more than what are their necessities. So in that case, these people, either individuals or corporate entities or government organizations, want to benefit from that excess money. So how do they do that? They have to go and deposit the money in a bank for a short term period, for whatever time period that money is available with them as a surplus, so that it is earning some money back to them, either in the form of interest if it's a bank deposit or in the form of improved market price if it's a security in the secondary markets or the primary markets. So instruments for surplus entities, what are the instruments which are available for surplus entities? So as I was mentioning, the person could actually go and put his money into a recurring deposit in a bank or a fixed deposit in a bank. When we are talking about recurring deposit, if he is sure that the excess money is going to be constant every month, that means every month out of his earnings, he is going to have around 5,000 rupees excess for which he has no use, and if it is with him, he may just utilize the money for unnecessary expenditure. So that money he can put it into a recurring deposit, so that at the end of the tenure it will earn him a good interest which can be used for some specific purpose. Similarly, he can also invest this money into equities. Now, equity shares are the shares which are offered by different companies, firms or organizations which want to raise capital for their own use, but they want investors to invest into their equity shares. And it's not a simple exercise. If somebody wants to invest their money into an equity share, they will look at what type of company it is, how profitable is the company, what have been its investment strategies of late, and then how each investment strategy has driven the company forward. So, taking all these into consideration, the investors actually decide on which company's equity shares to buy. So, once an investor buys the equity share of a company, he has two options. He can either hold the equity share for a long time period, so that he will benefit from the appreciation of the price of the equity share from the time he has bought it, or he can get into a speculative mode and look at whenever the price has increased to an optimum or a highest price, he can just sell off those shares in the market and then recover his investment into those shares. So, this is again a channel for entities which have surplus funds with them. Similarly, nowadays we have mutual funds, and mutual funds offer a lot of flexible investment opportunities. One of them is called as systematic investment plan, where an individual can start investing right from the amounts of around 500 rupees per month. So, it does not have to be a huge amount of 1000, 10,000 or even 1 lakh. With an amount of as small as 500 per month also, an individual can have investments into mutual funds. So, these are called as SIPs, systematic investment plans. And then you all are aware of PPF, the Public Provident Fund, which is again a voluntary contribution made by employees for their own safety after retirement. So, these are all the avenues which are available for individuals, corporates with surplus funds with them. Then what are the avenues which are available for the entities with deficit of funds? That means people who need money. Like somebody, like one of you wants to start a business and you don't have enough capital money. So, what do? You will have to approach a bank and you will have to take a loan from the bank. Similarly, not just an individual, even a company which wants to start a new line of business may need excess money than what is available with the company. So, in that case also the company will have to approach the bank for a loan, or the company has another option where it can also access the capital markets. Now, what are these financial institutions? These are nothing but banks and other players in the financial markets which help individuals and corporates to mobilize funds and also to effectively distribute these funds towards households and corporates which are in need of these funds. So, they are basically a channel through which funds are being diverted. On one side of the spectrum, you have people with excess money, corporates with excess money or government bodies with excess money. On the other side of the spectrum, there are people, corporates or government bodies which are in need of money for their investment purposes or for some other contingency purposes. So, who is acting as a channel between these two? It is these financial institutions. So, imagine all of you save your money, put your money into a savings bank account, or you are saving it as a recurring deposit or a fixed deposit. Now, what is the benefit for the bank? What will the bank do with all that money? The bank will not keep the money just with them. Instead, they will actually lend this money to people who are in need of it. Now, there is a difference in the interest rates if you have observed. The interest rate that you earn on a savings account is something around 4 to 5%. But when you apply for a loan from the bank, whether it is a commodity linked loan or a personal loan, the interest rate is very high. So, the differential in these interest rates is what the bank earns. That is the earning for the bank. So, that is how these banks operate as a channel between the entities which have excess money, so that is surplus money, and those entities which have a deficit of money. So, banks, insurance companies and mutual funds help usually help mobilize the savings. So, these are actually offering lot of instruments for individuals, corporates and governments also on how to save their excess money. Similarly, they also are acting as an avenue to the investors also, because the same banks are being approached by investors who want a loan. Then what are financial markets and what are the functions of financial markets? The financial markets refer to the institutional arrangements for dealing in financial assets and credit instruments of different types, such as currency, checks, bank deposits, bills, bonds, etc. So, all the institutional arrangements which enable the use of all these instruments are what are referred to as financial markets. Now, financial market does not necessarily refer to any physical or geographical location or a place, but it actually represents a network of communication and dealings among the participants. What are the functions of financial markets? Why should we have these financial markets in the first place? Now, what are they helping us with? They help us to facilitate the creation and allocation of credit and liquidity. When we are looking at credit and liquidity, credit is when you are borrowing money from a bank as a loan, that's a credit facility that you are availing. Liquidity is because of that borrowed money, you are now able to spend the money on whatever reasons or whatever investment opportunities that you were looking at. Then to serve as an intermediaries for the mobilization of savings. So, as we discussed this, how do these financial markets help us? Here they help us by offering different instruments where people can choose whether they want to, if they are a risk pro person, then they will definitely want to invest in stock markets, but if they are risk averse, then their safe bet will be putting their money into a recurring deposit or a bank deposit, a fixed deposit, a term deposit. So, that is how we have lot of options. As I said, even mutual fund systematic investment plan is also one option that is of late available, where the investments are growing by and large. Then another function of the financial markets is to assist the process of balanced economic growth. So, these banks and financial institutions ensure that there is a balance in surplus and deficit, so that there is an equilibrium that is being achieved. If there is excess of money available in the market, it leads to inflation. Similarly, if there is deficit of money in the market, then again that also leads to a toppled economic growth. So, these financial market institutions help us to maintain that equilibrium and also achieve the economic growth that is required for the progress of any country. Then the other function is to provide financial convenience. Nowadays, as you also must be operating, everything is at the click of a button. If you want to pay some bill, you can do it through your mobile using a UPI, whether it is a GPay or a BHIM app or any app that is available with you. So, all this is coming because of technological innovations which are also applied in the financial markets. So, that is how they are also providing some convenience. The transactions have become so easy now that sitting at any place, you can actually buy assets, you can buy food, you can get something delivered to wherever you are or delivered to some person whom you want it to be delivered. So, things have become that very simple now. And finally, to cater to the various credit needs of the business houses. What are the credit needs of business houses? Now, businesses actually run a lot on their own funds, but they also require some excess funds for which they approach these banks or financial institutions for loans. So, sometimes temporarily they may be out of cash, for which they may require some overdraft facilities. So, these are some facilities which are also offered by the financial institutions and the financial markets, which help sustain the businesses, their operations, so that the operations do not come to a standstill because of non-payment. So, overdraft is one such facility which is given to the corporate entities or firms. Again, this is also not given to all the entities. It is based on the credit worthiness of that firm or the individual that the overdraft is extended. Also, the limit of overdraft depends on the kinds of business transactions that the firm has been having. So, based on its financial transaction history, the terms are fixed for the overdraft facility that are extended to a particular firm. Then now let us look at the markets where all of these have to actually work together in tandem. So, there are two types of financial markets. We have capital markets which cater to the long-term fund requirements of the firms, and also the money markets which are more suitable for the short-term fund requirements of the firms. Now, capital markets are further classified into primary markets and secondary markets, whereas under money market you have two segments, which is unorganized money markets, which include the money lenders or the chit fund companies which are not registered or not under the regulatory perspective of the regulatory bodies. And you also have organized money markets where we have banks and financial institutions which also they come under the regulatory purview of RBI and SEBI, and they also give the customers the required services in the financial sector. Then what are capital markets? The capital market is a market for financial assets with a long or indefinite maturity. So, just now we also understood what are financial assets, one of them being the equity share or a debenture. Now, an equity share is a share which is an instrument which is issued by companies when they want to raise capital from the markets in general. So, as discussed earlier, this market does not have a physical demarcation or existence. The market, it can cover the entire world. Whoever across countries wants to apply and buy the share of a particular company, they are welcome to do so. What they have to have is, they need to have a bank account, they need to have a demat account, and that is what is sufficient for them to actually apply for a share and get a share. So, that is, now these equity shares, why we went to equity shares is, these are the shares which have long and indefinite maturity. Once the equity share is issued, there is no maturity period for an equity share. They are issued and they remain in the market as long as the company is existing, and companies are assumed to be there forever. Now, there is one of the accounting concept which is called as going concern concept, according to which the company, once it starts, is assumed to be there in the market for as long as the universe exists. Now, it may not be true, but that is one of the concepts which is proposed in the accounting theory. So, as per that, when a company issues an equity share also, it is assumed to be existing forever, so long as the company is there in operations. So, the capital markets deals with long-term securities with indefinite life and also with definite maturity period. Now, what come under definite maturity period? We have debentures or bonds. Now, debenture is an acknowledgement of debt by the company. So, if the company wants to, for example, raise an amount of 5 lakh rupees from the market, that is a very small amount, I am giving it for your understanding. So, they can issue debentures which are priced 1000 each. So, to raise 5 lakh amount, they will have to issue around 500 debentures with a face value of 1000 each. So, when they are announcing this issue of debentures, they will also give the features of the debenture. That means, what is the interest rate at which it is being issued and what is the maturity period. That means, for example, they can issue a 10% 5-year debenture, which means the interest rate on the debenture of 1000 rupees face value is 5% and it matures in a period of 5 years. That means, at the end of 5th year, the company will take back the debenture and pay back the principal amount to the investor. Now, what are primary markets? These are the places where the instruments are issued for the first time to the general public. So, it could be either an equity share or a debenture where they are trying to raise money through issue of either one of these instruments. So, what do? They actually announce an issue. They say that this is our company and we have these requirements. So far our business has been doing good. So, for that they prepare a document which is called as a prospectus. Now, prospectus contains all the details of a company right from when it was incepted, that means when was it started, who were its board of directors when it started, what was its operations when it started, what line of business were they into when it started, what was the initial capital with which they started the business, over the years what has been the earnings of the company, and if they have diverted, they have expanded their operations into other verticals, what are these verticals, and now what is their proposed line of business for which they want to raise money using the equity share issue or a debenture issue. So, a prospectus, it contains all of these details and it also tells the investors why should they invest or why should they buy the equity shares or debentures which are being offered by that company. So, based on that prospectus and also doing a little basic market analysis, the investors decide to either invest or not invest into the equity shares of a company. But if in case they want to invest into the equity shares, and that too when the company is offering it for the first time in the market, it is referred to as a public issue, right? It is called as initial public offering. And there are a lot of steps that are involved when a company has to go to through an IPO. It is called in short as IPO, initial public offering. So, they will have to actually decide what is the amount that they want to raise and what are the instruments through which they want to raise the amount, whether it is equity share or a debenture or a preference share. So, they can choose any one of these instruments to raise the money from the market based on the total amount required and the face value that they decide for each of these instruments. They can also give the number of shares or debentures that they want to issue during that particular public offering. So, we have a public issue, we also have a rights issue. Now, what is a rights issue? A rights issue is an issue which is actually shared only with the existing shareholders of the company, whereas the public issue is an issue which is open to all the general public. Anybody who wants to buy the share or instrument, they can apply for that issue, the public issue. But when it comes to a rights issue, the existing shareholders have a right on the issue. That means they have the right to apply to the issue. So they can apply, in addition to the existing shares that they have, they can apply for more number of shares that are being offered through a rights issue. That's the second type of way in which they can raise money. And the third one is private placement. Private placement, they don't actually advertise the issue at all in the to the general public or even as a rights issue. They only mention it to qualified institutional buyers or major banks who may come forward to buy the shares of the company. So that's called as a private placement. So these are three ways in which companies can raise capital that is required, and they can access any of these options. They can either go for a public issue or a rights issue, or they can also look at the private placement option. Okay, so once the shares are issued, now what does the investor do? Now, some investors are not happy with the functions of the company and they would want to sell these shares in the market. So that's the reason why we have secondary markets which are available. Now, secondary markets are nothing but the stock exchanges which are there across the country in major cities. Now, all of these stock exchanges are also regulated by the Securities Exchange Board of India. So these are the markets, absence of which would have collapsed the primary market. That means the primary markets are existing and supported by because of the secondary markets. So you must be looking at the share price increase and decrease. If you are looking at news or news articles or economic times or following any business news, you must be coming across share prices which are increasing for few companies, but for few companies they also decrease, and few companies there is no movement in the share price at all. Now, why does this happen? It happens again because of the demand and supply and because of the perceptions of the investors. So, if one investor assumes that a particular company is doing extremely well, he starts buying the shares of those companies, and he also shares that information with his colleagues, friends or well-wishers. So, what happens? All of them also try to buy the shares of that company. So, in the process, there is a demand that is getting generated for the shares of a particular company because more and more people are trying to buy the shares. So, when the demand is rising, what will happen to the price? The supply remains constant because the number of shares once issued by the company will remain constant. It does not increase and decrease with time. So, the availability of shares is limited, but the demand is more. So, that leads to an increase in the share price, which is a win-win situation for that investor who started buying the shares. Similarly, there could be another scenario where an employee of the company or somebody who is auditing the accounts of the company understands how the company's financials are, and once they know that the financials are not very good, the company may post some losses in a particular quarter, and if they share that information, which is very sensitive, then people who are already holding the shares of that company may start selling the shares of the company. Now, what will happen because of that? Again, it will give a crowd effect. I sell the shares of the company, I also share this information with my friends and my colleagues who also are holding the shares of the company. So, all of us together are putting up all the shares that we have of a particular company for sale. That means there is excess of supply. That means more and more people want to sell the shares of the company and nobody wants to buy, because if more people are selling the shares, obviously the prices are spiraling down. So, the prices are going to hit down. So, that again results in a loss for the investors. So, it is a very sentimental market. The stock markets are based on the investor perceptions and sentiments. So, that's how the markets operate. So, it is not just Indian market, it can have an effect from somewhere else also. Many years before this, we had a US subprime crisis, which was all to do with the housing loan crisis that happened in the US markets. But even that crisis had an impact on the stock markets across the countries. So, that is how sensitive the stock markets are, which are nothing but the secondary markets. Then we also have a government securities market, which is referred to as gilt-edged securities market, a market where government securities are traded. In India also, there are many kinds of government securities, short term and long term. So, long term securities are traded in the market and short term securities are traded in the money market. Now, securities which are issued by the central government, state governments, semi-governments, authorities like city corporations, the municipal corporations, the state electricity boards, all India and state level financial institutions and public sector enterprises are all dealt with in this market. Long-term loans market. Development and commercial banks play a significant role in this market by supplying long-term loans to corporate customers. Long-term loans market may further be classified into term loans market, mortgage market, financial guarantees market. Now, the term loan market is nothing but where people can go to a bank and obtain a loan for a specific tenure. It could be a 2-year loan or 5-year loan based on their requirement. Then let us look at who are all the market participants in all of these markets. So, we have discussed a lot about banks. So, all the major banks, whether they are private or public, are all the participants in both the capital markets and the money markets. We have primary dealers who deal in the government securities both in the primary and secondary markets. Now, these are the people who actually come out with the two-way quotes, the buy quote and a sell quote, and hence they are called as market makers. Then we have financial institutions which are similar to banks but are not banks, which offer some financial services to corporates and individuals. And then we have brokers. Now, brokers are agents who are approved by the capital market regulator, that is SEBI in Indian markets, who can operate on the stock exchanges. So, these people actually advise individuals on whether to buy or sell a security or hold a security based on their experience and also based on their technical analysis. So, they get paid some brokerage fee for the services that they offer. And then we have stock exchanges. We've discussed a lot about the stock exchanges. Investment bankers and merchant bankers are also regulated by SEBI, the capital market regulator, on who can become an investment banker, what kind of advices and services can be offered by the investment bankers. And not to forget the foreign institutional investors who are again authorized by SEBI to invest in our country's equity and debt markets through stock exchanges. So, as the name suggests, these are not Indian entities, they are foreign entities who are allowed to trade in our markets. And finally, we have custodians and depositories who help us in issue and maintenance of demat accounts of individuals and corporates. Depository participants maintain their customers' demat accounts, and when a customer wants to sell or buy securities, it is either credited or debited to these demat accounts. It's similar to a bank account, but instead of money, securities get debited and credited to a customer's demat account. So, you must have heard about entities like Sher Khan or Karvi Securities, where you need to open a demat account which is operated by them on your behalf. So, you can also do a direct purchase or direct sale, but it affects in your demat account, which is maintained by these custodians, which are again players in the financial markets, which are regulated by SEBI's rules and guidelines. So, all of these have to comply with the guidelines laid down by SEBI. So, for each of these market players, there are separate guidelines laid down by SEBI. So, which includes what is the amount of capital that each of these entities should have, what are the operations that they're allowed to do in these stock markets, whether they can become underwriters for an issue, whether they can become bankers to an issue, whether they can become registrars to an issue. So, there are several roles that these entities can play in the financial markets, and these roles, each role has a specific investment amount, a capital layout, and the functions which are defined for that particular role.